One major company announcement is a big deal. But three? In just 3 days? Across 3 different continents? Well, that's exactly what Indian pharma giant Zydus Life Sciences just did. So let's break down this incredible 72-hour blitz and figure out what it tells us about their global ambitions.
It was, honestly, a whirlwind. First up, they launched a high-tech diabetes solution right in their home market of India. The very next day, they secured a key generic drug approval in the super lucrative US market. And to top it all off, they got a groundbreaking new treatment approved for millions in China. 3 days, 3 continents, and 3 moves that tell us a whole lot about how they see the future of healthcare.
Okay, so let's start in India. This is where Zydus' first move wasn't about a new pill, but a totally new way of tackling a national health crisis. And yeah, it's powered by some seriously smart tech. To really get why this matters, you have to understand the sheer scale of India's diabetes problem. A landmark study found 101 million people are living with the disease. And get this, another 136 million are pre-diabetic, right on the edge. I mean, we're talking about 250 million people whose lives are impacted by this every single day. So for millions of people in India, managing diabetes is this constant struggle. It's what you'd call episodic monitoring. A painful finger prick here, a trip to the lab a few months later. This just creates a really spotty picture of their health, full of huge data gaps and missed warning signs. The entire burden of trying to connect those dots, it falls right on the patient.
And this is where Zydus' new system, it's called DaiaSense and GlucoLive, completely changes the game. It's a continuous glucose monitor that automatically streams a reading to your phone every 3 minutes. No more finger pricks, no more guessing. The AI then analyzes all that data to spot dangerous trends, and it can alert you, your family, and even your doctor in real time. It's basically like having a whole health team right in your pocket.
Okay, so from high-tech innovation in India, we're going to jump across the globe to the US. Over here, Zydus' strategy is all about navigating the really complex but hugely profitable world of the American pharmaceutical market. So the big news out of the US was an FDA approval for a drug called cevimeline hydrochloride. It's a generic medication, and what it does is bring relief to people with Sjogren's syndrome. That's an autoimmune disorder that can cause a really severe and just debilitating dry mouth. So you might be asking, why this drug in particular? Well, it's because it taps into a market that's worth nearly $27 million a year just in the US. It's not some headline-grabbing blockbuster, but it is a solid, reliable moneymaker. And for a company like Zydus, having a whole portfolio of these steady earners is absolutely crucial for long-term growth and stability. And you have to understand, this approval isn't just a one-off thing. It's actually their 436th FDA approval. It's the result of a relentless, 2-decade-long effort to really master the US generics market. So this isn't just about selling pills, it's about building a fortress of reliable revenue in the world's most important pharmaceutical market. All right, now for the final piece of this 3-day puzzle. China. If India was all about high-tech care and the US was about market stability, this move is about pure scientific innovation, and it's aimed at a massive and rapidly growing patient population. Zydus' big news in China is the approval of a new drug called Zydus. It treats a really serious complication of chronic kidney disease, or CKD. And with an estimated 120 million CKD patients in China, the potential impact of this drug is just enormous. This isn't just about helping patients, it's about Zydus planting its flag in one of the most important and fastest-growing healthcare markets on the planet. So here's the problem in a nutshell. Healthy kidneys produce a hormone called EPO. Think of it like the factory manager for your red blood cells. But with chronic kidney disease, the kidneys are damaged, and they just can't make enough EPO. So the factory slows way down, you get fewer red blood cells, and that leads to anemia, and all the weakness and fatigue that comes right along with it. And this is where the really cool science comes in. Zydus is a new kind of oral tablet that basically tricks your body into thinking it's at a high altitude, where there's less oxygen. It's this clever little biological hack. This stimulates the natural production of that key hormone, EPO, and it helps the body use iron better. The end result? More red blood cells and a direct counterattack on anemia. And you go, Zydus' managing director, Dr. Sharvil Patel, he really summed it up perfectly. He said, this is all driven by a commitment to improving patients' lives, and that partnering with a major Chinese company is the key to getting this groundbreaking treatment to as many people who need it as possible. So, an AI device in India, a generic drug in the US, and a brand new innovation for China.
On the surface, they might seem like three totally random moves, but when you start connecting the dots, a brilliant and really audacious global strategy starts to come into focus.
It's this masterful three-pronged attack. In India, it's all about dominating their home turf with cutting-edge patient-focused tech. Then in the US, the goal is to secure that financial foundation with a massive portfolio of reliable generic drugs. And finally, in China, it's about breaking new ground with real innovation in a huge growth market. See, each move is perfectly tailored to the unique challenges and opportunities of that specific region.
So yeah, this wasn't just a busy week for Zydus' press department. This was a masterclass in global strategy. It's a company that's playing three-dimensional chess, making these bold, calculated moves in the world's most important healthcare markets all at the same time. And it really shows they have a crystal clear vision for how to win on all three fronts.
This 72-hour blitz really gives us a fascinating look into the mind of a company that is thinking big. It's a company that is not afraid to play on the global stage and to play to win. Which leaves us with one big question. After a week like this, what could they possibly do for an encore?
In August 2025, if you looked at a chart for Zydus Life Sciences, I mean, the stock was absolutely flying high.
Oh, it looked completely invincible.
Right. But then by January of 2026, looking at that exact same chart, it felt like staring at a slow-motion car crash.
Yeah, a really brutal sell-off.
It was. And today, we're doing a deep dive into a single incredibly detailed screenshot from the Nuvama trading platform. And I think it really proves why panicking during a market drop like that is, well, it's often the worst thing you can do for your portfolio. So, welcome to the deep dive.
Thanks. Yeah, we're basically treating this single image as like a forensic crime scene today.
I love that.
Or actually maybe a battlefield is a more accurate metaphor here. We're looking at a weekly candlestick chart for a stock listed as ZYDDS Life on the National Stock Exchange.
And just to set the stage for you listening, our goal today isn't to just, read a bunch of boring data points off a screen.
No, definitely not. We're here to reverse engineer the human psychology, the fear, the greed, the exhaustion that's actually driving those numbers.
Because even if you are an active trader, like someone who watches the tape every single day, it is remarkably easy to get totally lost in the intraday noise.
Oh, that's so easy. You get tunnel vision.
Exactly. So taking a step back to read this sort of matrix of market sentiment frozen on a single weekly frame, it's a really vital exercise. We're going to break down the price action, the momentum, and the volume between early 2025 and March 2026.
Because every single tick on this chart represents a human decision. Or, well, an algorithmic decision programmed by a human.
Right. Someone deciding to buy, someone else deciding to bail out.
Exactly. And when you aggregate millions of those individual decisions over time, you get these really distinct mathematical and psychological patterns. That underlying architecture is what we're hunting for.
So let's zero in on the bleeding edge of this timeline first. The very top left of the chart has this data block that gives us the parameters for the most recent week.
The standard OHLC format.
Right, the open, high, low, close. So we've got the open at 888.0, the high at 936.15, the low at 885.0, and the close at 905.90.
Which is a lot of numbers to throw out at once.
It is, yeah. But we all know the basic mechanics of how a candle works. I just like visualizing it as this violent, week-long game of tug-of-war. It really contextualizes the aggression.
I like that analogy.
So picture it. The opening bell rings on Monday morning, and the flag in the middle of the rope is sitting at 888.
Okay, the starting line.
Right. And the bears, the sellers, they immediately try to drag it down into the mud.
But they hit a brick wall pretty fast.
Exactly. They only managed to scrape 885.10 before the bulls completely hijacked the momentum.
Yeah, the buyers essentially absorbed whatever residual selling pressure was left over at the open, and then they just went on an absolute tear.
They grabbed the rope and ran with it.
They did. They dragged the price all the way up to that high of 936.15.
Which is a huge intra-week swing.
Massive.
Yeah.
But, they couldn't hold that absolute peak going into the Friday afternoon close.
Right, because people want to take profits before the weekend.
Exactly.
Yeah.
Day traders are squaring their positions, so the sellers clawed back some ground, forcing the final whistle to blow at 905.90.
But the resulting visual on the chart, that solid green candlestick, that's a definitive flag planted by the buyers.
Absolutely. Closing almost 18 points higher than the open, it paints that green body, and it tells us who fundamentally controlled that specific week.
But, and this is the big but, A single weekly battle doesn't dictate the trajectory of the whole war.
No, not at all. Context is literally everything in technical analysis.
Right, a green candle only matters if we understand where it's showing up on the map, which means we need to zoom out and look at the macro trend.
You can't just read the last page of a book and claim you understand the plot.
Totally. And the plot here is a textbook roller coaster. If you trace the visual journey from left to right, starting in early 2025, you see this massive, euphoric run-up.
It was a beautiful chart back then.
It really was. It peaks around August and September. The price is just soaring well past the 1,000 mark. Everyone seemingly wanted a piece of Zydus.
FOMO was in full effect.
Oh, big time.
Yeah.
But then the bottom just falls out. Starting in October, we see this relentless cascade of red candles.
Just week after week of selling.
Yeah, bringing the price tumbling all the way down below the 869.50 marker by early 2026. And looking at a multi-month slide like that, I mean, the immediate emotional instinct is panic.
Of course. It looked like the company's falling apart.
Right. You assume a structural failure. But I'd argue that a drop of this magnitude, especially after such a steep parabolic climb, isn't that just the market violently exhaling?
That's a great way to put it. Markets function a lot like respiratory systems. They simply can't inhale indefinitely.
They'd pop.
Exactly. That aggressive climb to the August peak was a classic overextension. The smart money, the early institutional buyers who accumulated shares way before the run-up, they saw that retail euphoria, and they started aggressively taking their profits.
So that cascading red slide isn't necessarily a panic.
No, it's a brutal but entirely necessary period of consolidation. The market is just aggressively repricing the assets.
Stripping away the hype.
Right, stripping away the speculative froth to find the true intrinsic floor.
And we actually see that floor forming right at the end of the chart. Heading into February and March 2026, the bleeding finally stops.
The sellers pushed and pushed for months.
But right around that 869.50 zone, the buyers stepped back in. They drew a line in the sand, limit order stacked up, and we got that nice upward hook.
Because the asset simply became too cheap to ignore, the risk-to-reward ratio finally flipped back in favor of the buyers.
Yeah, so that 869.50 zone, that's what chartists would call a major support level, right?
Precisely. It's the psychological basement. The sellers threw literally everything they had at the market to try and break below it, but the demand there was just overwhelming.
And the fact that the stock absorbed all that selling pressure and managed to form multiple green candles off that base?
That's the first structural evidence of a new inhale.
Okay, so a bounce off a support floor is great, but we need to know if it has genuine structural momentum or if it's just, a dead cat bounce that's going to roll over and die again.
Always a valid concern.
Which brings us to the dynamic envelope wrapping around all these price candles. On the chart, we have this upper green band, a lower green band, and a middle trend line.
The volatility bands.
Yeah. I always visualize these as the bumpers at a cosmic bowling alley.
Oh, that's fun.
Right? The stock price just bounces back and forth between them. But unlike a physical bowling alley, these bumpers expand and contract dynamically based on how wild the market gets.
Yeah, they function very similarly to Bollinger Bands. They're calculated using standard deviations away from a simple moving average, which is what that middle center line represents.
And the math behind that is really crucial for reading the story here.
It is, because when the market gets chaotic and volatile, the standard deviation mathematically increases, right?
Okay.
Which throws those outer bands much wider.
Like the lane getting wider.
Exactly. And when the price consolidates and things calm down, the bands squeeze tightly back together.
So notice how during that euphoric August 2025 peak we talked about, the price candles were literally grinding against the very top green band.
Just right in the ceiling.
Mathematically, that represents extreme, unsustainable momentum, doesn't it?
Absolutely. The price was living multiple standard deviations above its norm. It's a statistical anomaly at that point.
And I have to imagine that in today's highly automated market, that is exactly the kind of anomaly algorithmic trading bots are hunting for.
Well, they feed on it.
They see the price pushing 2 standard deviations too high, and they just automatically start shorting it, betting heavily on the snapback to the mean.
Algorithmic mean reversion strategies dominate that kind of price action. The bots are programmed to punish overextension.
And we see the exact opposite scenario playing out during the painful dip in early 2026.
Right. The price is riding the bottom gutter.
Yeah, pushing hard against that lower green band. It became statistically oversold, which eventually triggered the buying algorithms to step in at that 869.50 support level.
But the most critical development on this entire chart is how the price is behaving right now in March 2026.
Oh, for sure. Because for months during that grinding downtrend, every single time the price tried to rally, it hit that middle moving average and just got swatted right back down.
The middle line acted as a rigid ceiling.
But with this recent close at 905 point Undina Rai, the price finally broke definitively above that center line.
And conquering that mean is a massive psychological and mathematical shift.
It changes the whole vibe.
It really does. In technical charting, crossing and closing above that middle threshold is viewed as a definitive shift in the immediate trend bias.
So it's transitioning from a negative defensive posture to a positive offensive one.
Exactly. It tells the broader market that the buyers are no longer just defending the basement, they are actively pushing up the stairs.
But pushing up the stairs takes serious energy. Breaking a ceiling requires capital.
It's expensive.
Right. And a technical breakout can so easily turn into a bull trap if the buyers are already exhausted by the time they smash through the glass. So we need a way to measure their stamina.
Which is where the lower panels come in.
Yes, sitting directly under the main price action is a subchart for the RSI, the Relative Strength Index. And this one is set to a 14-week period. It's this jagged white line oscillating horizontally around a flat baseline labeled 50.000.
The RSI is honestly one of the most elegant tools in technical analysis.
Because it functions like a scudometer.
Exactly. It's a speedometer for market emotion. It calculates the magnitude of recent gains against the magnitude of recent losses over those 14 weeks. And it generates a reading from 0 to 100.
Okay, so when that line spikes above 70, the market is classified as overbought.
Right. The buyers are euphoric, they've deployed all their available capital, and a pullback is statistically imminent.
And we actually saw that exact overbought reading during the August peak. But looking at the extreme right edge of the RSI for March 2026, the line is hovering completely neutral. It's resting right on that 50.00 mark.
Neither overbought nor oversold.
Right. And initially, seeing a 50 might look like apathy, just a flat line. But if the RSI is measuring the average momentum of the last 14 weeks, and we just had a massive multi-month drop followed by a really sharp hookup, wouldn't a reading of 50 actually mean the recent bullish momentum has completely neutralized the long-term bearish momentum?
That is spot on.
So it's not apathy at all. It's like a Mexican standoff.
I love that. Yes, your deduction is perfect. A 50 on the RSI, especially after a prolonged downtrend, is actually a hidden bullish signal.
Because it represents balanced tension.
Exactly. The buyers have managed to push the price up, they conquered the moving average, and they shifted the trend. But crucially, they haven't exhausted their capital to do it.
The RSI still has plenty of mathematical runway before it hits that overbought 70 territory.
The market is basically taking a deep breath. It has the emotional and financial capacity to sustain a much larger rally because the buyers are not overextended yet.
Okay, so the price broke the structural ceiling, the trend bias is positive, and the buyers have plenty of stamina left in the tank. It sounds like an incredibly bullish setup.
It does.
But there is a glaring contradiction sitting at the very bottom of this Nuvama screenshot, the volume chart.
Yes, the volume.
We have these vertical bars measuring the absolute quantity of shares traded each week. The y-axis markers are at 18L, which for those unfamiliar means 1.8 million shares, and 97L, meaning 9.7 million shares. Let's look at the historical footprint first.
Get back at March and April of 2025.
Yeah, the volume bars back then were absolute skyscrapers. They were easily blasting past that 97L mark. The conviction was just deafening.
That towering volume is the unmistakable footprint of massive institutional participation.
Mutual funds, pension funds, hedge funds.
Right. The heavyweights were accumulating shares and throwing billions of dollars at the stock. High volume validates the price action. It tells you the move is real because the biggest players in the game are financially committing to it.
But look at the volume right now on the extreme right of the chart.
It's a very different picture.
It's tiny. The price is staging this beautiful technical recovery, hitting 905.9 arrow, crossing thresholds, planting green flags. But the volume bars underneath are microscopic. They're barely scraping the 18L baseline.
The price is moving up, but the crowd is basically whispering.
Exactly. And a technical breakout on anemic volume screams divergence to me. If the big institutional money isn't participating, this upward structural momentum feels, I don't know, incredibly fragile.
You're right to be cautious. Divergence is the ultimate lie detector in charting. The price is telling a story of strength, But the volume is completely refusing to corroborate that story.
It's like a witness changing their testimony.
Exactly. A true, durable reversal from a brutal, multi-month downtrend typically requires massive volume to sustain it. You need those institutional whales stepping in to absorb any lingering sell orders.
Right, the sell orders from the people who bought at the top and are just waiting to break even.
The bag holders.
Yeah, the bag holders. The people who bought at 1,000 in August have been sweating for 6 months, just praying for the price to bounce back to 1,000 so they can sell without taking a massive loss.
Those exact traders. They create an invisible ceiling of supply. And to punch through that supply, you need overwhelming demand.
Which translates to high volume.
Right. The fact that this current recovery to 905.90 is happening on such low volume implies extreme institutional caution. Retail traders and maybe some smaller algorithms might be inching the price up in a low liquidity environment, but the heavy money, they are sitting firmly on the sidelines.
They're waiting for absolute, undeniable confirmation before they commit real capital to a new bullish cycle.
They don't want to get caught in a trap either.
So the foundation of this recovery might be built on sand, at least for the moment. Let's pull all these threads together to synthesize what this chart is actually telling you. Based on this single snapshot, ZYG's life in March 2026 is caught in this fascinating high-stakes transition.
It's at a real pivot point.
It survived a grueling 6-month slide. It found a concrete floor around 869, and the bulls just planted a major flag by winning the weekly tug-of-war and closing strongly at 905.90.
And it broke structural resistance by crossing that middle volatility band.
Right, and the RSI shows the buyers have plenty of gas left in the tank to push higher.
So the technical mechanics are all flashing green. The structure for a massive recovery is entirely in place.
Yet, the ghostly quiet volume tells us the biggest players on Wall Street, or Wall Street in this case, they aren't convinced yet. It is a market suspended in amber, a perfectly balanced equation waiting for a new variable, a catalyst, to tip the scales and bring the loud crowd back into the stadium.
It really is a masterclass in why you can never, ever rely on a single indicator. Price action tells you what is happening, but volume tells you how much you should actually trust it.
Which brings me to a final provocative thought for you to chew on. We've spent this entire deep dive analyzing how these candlestick patterns, these volatility bands, and momentum indicators, how they reflect human psychology.
We treat the chart as a map of human behavior.
Exactly. But remember those algorithmic trading bots we mentioned earlier?
The ones hunting for standard deviations.
Yeah. In a modern financial market where thousands of sophisticated algorithms are scanning these exact same volatility bands, and they're waiting for the exact same moving average crossovers to execute massive block trades at the speed of light. At what point do these charts